chart here, this is an outlook by Wall Street right now for 2026 year-end price targets. They're all pretty optimistic. There's not one up here that actually shows a decline for next year. We'll see what this year comes out to be, but right now analysts are very, very optimistic about returns for this coming year. There's certainly a lot of things to think about in terms of things that could go potentially wrong. And there's not enough consideration really built around those risks in a lot of people's portfolios. There's an interesting chart that came out talking about risk. This was kind of what things pose the biggest risk to the markets this year. So tech valuations in terms of AI, the new Fed chair coming out upsets things, a crisis in private capital, bond yields rise more than expected, so forth and so on. There's all these risks. I can almost guarantee you that whatever causes the market to correct this year will be none of those things. And the reason is that whatever we can think of, we've already priced into the markets, right? Over the last couple of months, the big cap names, the Mag 7, they've struggled over AI concern. We saw Oracle get hit because of concerns about their debt, what's going on with them kind of taking on a lot of debt to build out data centers. We've seen NVIDIA and Microsoft and others kind of struggle here price-wise. Those questions about AI adoption issue, that's already being factored into the prices of these stocks. So that's probably not going to be the case. And particularly when it's the most widely expected case, that's already getting priced in. The hedge fund managers, professional managers, et cetera, already hedging that risk in their portfolios. So you can almost bet your bottom dollar that that's not going to be the thing that derails the markets this year. What will derail the market is something that is entirely unexpected. Why is that the case? Because again, if I'm expecting something and I'm a professional hedge fund manager, I'm hedging that risk. I'm short this, I'm long this, I'm arbitraging the deal, whatever. I'm pricing all that in. Those expectations are already getting bought in. So what causes markets to decline sharply is when something occurs that all of a sudden Wall Street has to go, hey, that $300 in earnings I was expecting this year, that ain't going to happen. It's going to be $275. Well, if I drop the E in valuations, I've got to drop the P to keep valuations just where they were. So if earnings go from 300 to 250, I've got to drop the price enough to keep valuations at the same level. And that unexpected event, whatever that was, that causes that repricing in earnings, causes a repricing in the markets. But that's why it has to be a surprise. If it's already kind of known and everybody's already looking at it, the valuations already represent that risk. It'll be something that we are not talking about or even thinking about right now. Let me give a good example of this. And this guy gets up on television and holds up this sign showing tariffs. All of a sudden, that moment rocked the market because nobody was expecting that.
Catch me daily on The Real Investment Show. The link is in the description.